We've come up with 6 different ways we believe businesses are valued. We're going to go through those 6 different ways, starting with the comparable method. So the comparable method, very simple. You own a business. Other businesses that are like yours have sold at some point. If it's a restaurant, for example, you own a restaurant. Other people have sold restaurants before. What did they sell them for? You can use the comparable method. We know this very well because of the real estate world, right? We compare home sales to other home sales to be able to come up with pricing. Market capitalization. That's taking another company's share price and multiplying it by the total number of shares outstanding. And then times revenue. It's not as complicated as it sounds. How much money does this business make in a year? You know, that P&L, that profit and loss statement. How much money does it make? And what is the reasonable multiple of that revenue? How many years of revenue would you want to add would be the worth of that business? The net income multiplier, which is actually very similar. We talk about EBITDA, earnings before interest, taxes, depreciation, and amortization. I was in the restaurant business. The president and CEO of that business would only ask about one thing. What's your EBITDA? What is your percentage of gross revenue? That's the people coming in and paying for that food. And they would have it down to EBITDA, earnings before those uncontrollables. So that really gives them a clearer picture of what the business is earning. And then book value, the value of all the shareholders' equity and all the assets on the balance sheet, the things that the business owns. So I'm buying the business. What are all the shares worth? And how many shares are there? How much did the building cost? How much did the table cost? What do you own that you can sell? And then the liquidation value, a very similar feature here. You go through and you look at all of the inventory. What is it worth? Probably at a discount because the goal is to liquidate your fundings. You see these in foreclosures where a business must sell. Everything must go. You've seen the signs, the guy on the corner waving the sign and all that. Everything must go. It's because they're being forced to sell. They're being forced to liquidate. So the liquidation value is whatever the judges, whoever is evaluating that business says it's worth based on the inventory and how quickly they can get rid of the inventory.